Hello, ladies and gentlemen. Welcome back to the channel. My name is Akram Shaban. I hope you guys are doing great. We're gonna do something a lot more different than we usually do. All right. So today, I'm going more deep into the project Agora, and I hope you guys are just ready for it because I want you guys to bring out your magnifying glass here because we're going on to detective mode and actually going on detail into what we just covered in the previous video, but just more in detail. All right, so I'm gonna walk you guys through it really quickly and short, and just make it because I highlighted the most important stuff. And yeah, let's just hop into it. Don't get overwhelmed. I'm just walking it through it just slowly. All right, so blueprint for the future monetary system, improving the old, enabling the new. By the way, this is from the BIS. If you guys know the previous video, you would know what this information is out, and especially when you follow, of course, if you follow me and Rasan, you would know the research, but this is just more in depth. All right, so the key takeaways here: a new type of financial market infrastructure, a unified ledger, could capture the full benefits of tokenization by combining central bank money, tokenized deposits, and tokenized assets on a programmable platform. All right, so I've been doing my homework here. And then another one here, which is another important one: multiple ledgers, each with a specific use case, might coexist, interlinked by application programming interfaces to ensure interoperability, as well as promote financial inclusion and level playing field. All right, let's keep going here. With the advent of the technology age, paper ledgers became digital, adding impetus to it dematerialization of money, as well as claims on financial and real assets, electronic bookkeeping, accelerated paper-based processes, allowing accounts to be updated at the speed of light. Through dematerialization and digitalization, the interplay between money and the economy has wrought profound changes on society at large. Today, the monetary system stands at the cusp of another major leap. Following dematerialization and digitalization, the key development is tokenization, the process of representing claims digitally on a programmable platform. Tokenizations could dramatically enhance the capabilities of the monetary and financial system by harnessing new ways for intermediaries to interact in serving end users, removing the traditional separation of messaging, reconciliation, and settlement. Tokenization can unlock new types of economic arrangement, with the frictions inherent in the current monetary system have hitherto made impractical. All right, so moving on. I know this is too much. This is much more nerdy than we used to be, but here. All right, so away from crypto, efforts by commercial banks and other private sectors groups. That's actually one of the assets that we invest into, by the way. When it says private sectors, that means Ripple. Have explored the capabilities of tokenization for real-world use cases. Ripple. All right. I'm going to scream Ripple every time I hear private sector. All right. So, in particular, commercial banks issue deposits, the most common form of money held by the public. Supported by regulation and supervision, this two-tiered structure preserves the singleness of money, the property that payments denominated in the sovereign unit of account will be settled at par, even if they use different forms of privately and publicly issued monies, while the current monetary system has served society well. These fictions result from the current design of a monetary system where digital money and other claim resides in siloed proprietary databases located at the edges of communication networks. These databases must be connected through third-party messaging systems that send messages back and forth. Oh my God. Okay. See, it's okay. So I don't want to stop here a little bit and put some of my input. Now we're seeing, as we're just walking through this whole thing, this whole research I'm just doing my homework on, things are much more different, a little bit different. Some of the things that we thought of how this is going to work actually happens, and some of things were just basically we didn't know about. And but yeah, private sectors like Ripple, of course, explored the capabilities of tokenization for the real world use cases. We have over here supported by regulation and supervision. This two-tiered structure preserves the singleness of money. So of course they're just saying that needs to be, of course, regulated and supervision of all this stuff. And located at the edges of communication networks, that databases must be connected through third-party messaging systems that send messages back and forth. So there's going to be a third party here, messaging, of course. All right, so let's move on here. Just a little bit deep breath here, just not just to dive in quickly. All right, so indeed, these emerging demands may be just the tip of the iceberg, which is for sure, as services delivered through smartphone apps make deep inroads into people's daily lives. Users expect the same seamless operation of the monetary financial system as the seamless interaction of apps on their smartphones. So of course, again, smartphones are really a big part of this right now. Here, of course, we have to use technology to transact with digital currencies. So that's known as well. All right, so this is where it gets important right here. This is where the thing that really shows much more of how the CBDC things work, how these ledgers and unified ledgers and these private sectors and of course everything. There's a lot more here, and how everything is tokenized. This is gonna be the meats and beans here. All right, let's get into it. Let's dive in. So this chapter presents a blueprint for a future monetary system that harnesses the potential of tokenization to improve the old and enable the new. The key elements of the blueprint are CBDCs, tokenized deposits, and other tokenized claims on financial and real assets. The blueprint envisages, I don't even know how to spell that word, but these elements being brought together in a new type of financial market infrastructure, FMI, a unified ledger. The full benefits of tokenization could be harnessed in a unified ledger due to the settlement finality that comes from the central bank money residing in the same venue as other claims. Holy crap. Okay. So, leveraging trust in the central bank, a shared venue of this kind has great potential to enhance the monetary and financial system. Again, unified ledger here. Of course, this is an important ledger. Unified ledger basically is just a ledger where the whole world can transact through that ledger. Unified. So it's like unified. You know what I mean? So unified ledger, and of course, together in a new type of financial market infrastructure, FMI, unified ledger. All right, so a unified ledger transforms the way that intermediaries interact to serve serve end users through programmability and the platform's ability to bundle transactions composability. Oh my God, this is just nerdy stuff here, but all right. So a unified ledger allows sequences of financial transactions to be automated and seamlessly integrated. This reduces the need for manual interventions, and reconciliation that arise from the traditional separation of messaging, clearing, and settlement, thereby eliminating delays and uncertainty. The ledger also supports simultaneously and instantaneously settlement, reducing settlement times and credit risks. Settlement in a central bank money ensures the singleness of money and payment finality. Oh my God. So now you guys get the whole idea of this unified ledger. It's just more in detail. Oh my god, yep, we have a reading here too. So, for example, one ledger could aim at improving security settlement while another could facilitate trade, finance, and supply chain. So, again, just to let you guys know, so let's just proceed here because it actually explains it right here. So, tokenized forms of money would figure in each ledger to provide the transaction medium, right? Each unified ledger would bring together only the intermediaries and assets required for each application. The scope of a ledger will also determine the irrelevant players that must be involved in the governance arrangements. Separate ledgers could be connected through application programming interfaces APIs, or as their scope expand over time, they could incorporate additional assets and entities or merge together. All right. Some of the benefits envisaged from the unified ledger could be reaped by interlinking existing systems through APIs into a network of networks, while such as network of networks would still consist of separate systems and fall short of fully fledged programmability across systems. The worst drawbacks of siloed systems could be mitigated. Wow. Okay, so of course I'm my brain is a little bit fried here, but I know you guys might be too much for you guys, but this is much more important. I have actually researched so much and I've read so much and I've done my homework so much to bring this thing out for you guys and just have you knowing exactly how this whole system going to work. I mean, probably there's other adjustments going to happen later, but at least we know the draft and we understand how those things are going to play. And like what you said, and this how this document said, leveling the playing field. All right. This next stage in the financial system journey will be one that combines the best efforts of both the private and public sectors. Boom. Private and public sectors. Ripple, right? Private sectors, public sectors. So there's going to be a private ledger and a public ledger. And of course, unified ledgers. Central banks could work with regulated private entities, Ripple, to develop technology solutions and standards to meet specific use cases. Again, they're not gonna mention the name. Okay, so I'm just gonna put this out right here, but they're not gonna mention any private sector. It's called private sector for a reason. Ripple is one, of course. All right. So again, every time I hear specific use cases, I always hear like Brad Garlinghouse saying that. All right, so moving on. Proper oversight and supervision will be prerequisite for this endeavor in embracing evolution and change. Central banks and the private sector should follow key guiding principles to ensure that the monetary system harness innovation for the public interest. First, the tried and tested division of roles between the public and the private sector in the two-tiered system remains the cornerstone. The second principle is upholding a competitive level of playing field that promotes innovation and financial inclusion. And third, the future monetary system needs to meet the highest standards of data security and privacy, while ensuring system integrity by guarding against illicit activities such as money laundering, financing of terrorism, and fraud. Okay, so holy shit. So, okay, there's a lot of things here we actually know, and some things we don't actually know. So, one of the things that we know about is the more control over these digital currencies, right? Normally, when people want to fund, for example, Palestine, of what's going on in Palestine right now, it's horrible. But if you fund Palestine with money or aid or anything, that's literally financing of terrorism. All right, that's how they're gonna label it. All right, money laundering. Right, money laundering is a big thing that we see today in today's world. Even fraud. So there's a lot of control here. There's more gripping their hand much more tightly on where is the money is going, where it's going to you, to the people you're transacting with, regardless the business or whatever product you're trying to buy. or you're trying to send money, receive money, where is it going? So there's a lot of hand gripping here from what I'm seeing and reading here. So all right, so concrete examples show how this kind of integration could improve the old and enable the new. The final section discusses high-level guiding principles on scope, governance, incentives for participation, operational resilience, and privacy. That's a mouthful. So, okay, I didn't have anything here. I just want to highlight just the most important thing. Tokenization, the process of recording claims on financial or real assets that exist on a traditional ledger on a programmable platform. It introduces two important capabilities. First, by dispensing with messaging and the reliance on account managers to update records. It provides great scope of composability where several actions are bundled into the one executable package. Second, it enables the contingent performance of actions through smart contracts. Logical statements such as if, then, or else by combining composability and contingency. Tokenization makes the conditional performance of actions more readily attainable, even quite complex ones. Oh my god, there's a lot of crazy vocabulary here, of course, as well. But yeah, okay, so this is what you guys see here. This is RAMP's map asset to their tokenized counterparts on programmable platforms. You see tokenizing transformation. This is the RAMP, locked assets, and then tokenized assets. Traditional system. This is the programmable platform. All right. So central bank money and the settlement finality that it brings such a firmer foundation for tokenization. The full potential of tokenization is therefore be harnessed by having central bank money reside on the same venue as other tokenized claims. This is because programmable transactions could incorporate settlements using the economy's unit of account as an essential part of the tokenized arrangement. Sorry guys for the cutting here because I'm getting mind fucked of things of what the hell is going on. So there's so much information. I know it might be overwhelming for you guys, but this is what I'm trying to push and trying to show. There's a lot of people who, of course, they talk and of course Ripple and crypto and CBDCs and all these kind of stuff, but I am deep down of pulling information and bring it out and actually sharing it with you guys. So I love this kind of stuff and I do this for a living. So, all right. So for this reason, the development of a wholesale CBDC is a core to the functioning of a tokenized environment. As a tokenized means of settlement, wholesale CBDCs would serve a similar role of reserves in the current system, but the added functionalities enabled by tokenization. All right. Crazy. Okay, this gets more important here as well. The BIS Innovation Hub, in a partnership with central banks around the world, stand at the forefront of experimentation with CBDCs and tokenization. BIS on the top, the rest is on the bottom. All right, they are the forefront of the experimentation with CBDCs and tokenization. All right, so here it gets crazy. Here, box A. The BIS innovation stands at the forefront of experimentation with central bank digital currencies and tokenized assets. The work includes projects within a cross-jurisdiction and in multiple currencies, often in partnership with the private sector. All right. So, experiments with the CBDCs have shown that tokenization can reduce the complexity of security settlement by facilitating simpler and more direct holding systems, as shown in Project Helvetia. Using wholesale CBDC as opposed to linking real-time gross settlement systems to financial infrastructure could provide greater scope for future innovation and efficiency gains in the settlement process. Tokenization also increases operational transparency as shown in Project Jura, Dunbar, and Enbridge. We spoke about Enbridge. You guys check that video out, the previous video we made about Project Enbridge. All right. These three completed wholesale CBDC projects focus on use cases where CBDCs were transferred against either another CBDC, payment versus payment, PVP, or tokenized securities, delivery versus payment, DVP. All right, so PVP is payment versus payment, and DVP is delivery versus payment. Just so you guys know what that means as well. Project Jura, right? For example, yeah. So for example, right here, for example, Project Jura networks allow the platform to respect jurisdictional boundaries and data location requirements, and notaries allow central banks to control and monitor transactions in their currencies, both in terms of payment and PVP settlements. Moreover, programmability allows new types of contingent payment, while certain policy measures, e.g. capital controls, capital controls, can be built in form from the start. Beyond CBDCs, other projects have explored the particular practical and technological complexities and tokenized assets in context of green finance. Project Genesis and Trade Finance, Project Dynamo. All right, so as you guys can see here, so this whole table right here, table A, a bird's eye view of BI's Innovation Hub projects on CBDC and tokenization. Those are the projects, and those are the main use cases. And this is the banks. This is BIS Center, okay. And these participants. And this is the relevant currencies right here. I'm telling you, I'm like in here, like really pulling this information out and actually showing you guys. By using its own balance sheet as the ultimate means of settlement, the central bank provides the means of ensuring the finality of wholesale payments. As the trusted intermediary, it is the central bank that debts the account of the payer. All right, so again, another graph, non-barrier instrument model of tokenized deposits. So you have Bank One, John, whatever. So here it explains that as well, right here. So the dotted lines, right? The dotted lines denote know your customer KYC boundaries. The red rectangles indicates the liabilities of the respective issuers, so Bank 1 and Bank 2, and the central bank, right? So you see that, and with the yellow arrows are originating from the holder of those liabilities. All right, so D1 and D2. Okay, and denote the tokens held by John and Paul, which are liabilities for their respective banks. Okay, something happened. I actually did something here. I think that's the undo button. I have no clue. But yeah, we're just moving on. It's okay. All right, so third, tokenized deposits would ensure the banks could continue to offer credit and liquidity in a flexible way. In the current two-tiered monetary system, banks provide individuals and firms with loans and on-demand access to liquidity through, for example, credit lines. All right, so this where it gets a little bit more interesting here. It picks up. I know this is too much, but this is much more important because this is stable coins. As we know, guys, Ripple has a stable coin, of course. It's RLUSD. And there's a lot of things that what is going to provide for these central banks. All right. Let's wrap up. Let's go. All right. So stable coins are an alternative form of private tokenized money. Okay. But they have important shortcomings. In contrast to tokenized deposits, stablecoins represent a transferable claim on the issuer, akin to a digital bearer instrument. A payment using stablecoins transfers the issuer liability from one holder to another. So, imagine that John holds one stablecoin unit, SCU, issued by a stablecoin issuer, for example, let's say Ripple, right? When John pays Paul, SCU1 joins claim on the stablecoin issuer is transferred to Paul, who did not have a claim on that issuer before the transfer. You following me right here? This is important. There is no need to update the stablecoin issuer's balance sheet, and there is no settlement on the central bank's balance sheet. Whoever holds the instrument has a claim on the issuer and can transfer it without the need of consent. Okay, listen. Or involvement of the issuer. In this case, Paul is left with a claim on an issuer he may not trust. Boom. Alright, so what does this mean? This means, okay, a keyword here. There's a keyword here. Need for consent or involvement of the issuer. So there's no so right here, who did not have. Okay, so let's go here. John's claim on the stablecoin issuer is transferred to Paul, who did not have a claim on the issuer before the transfer. There's no need to update the stablecoin issuer's balance, and there's no settlement on central bank's balance sheet. Whoever holds the instrument has a claim on the issuer can transfer it without the need of consent or involvement. That really means that whoever holds the instrument has a claim on the issuer and can transfer it without the need of consent. Well, people who don't have it and don't have this stable coin, I think, or this asset or this technology or whatever, the stable coin or whatever, let's say XRP, right? Then if you don't have this asset, then you don't have the power to transact with it. You have to have consent. All right, that's what I'm getting at, but that's what I see it. Right? So whoever holds the instrument has a claim on the issuer. What's the instrument? Ripple, XRP. Right? So yeah, the instrument is XRP. My bad, not the company, but yeah, XRP. Okay, and whoever holds it, they don't need a consent to use it or transact with it. All right. As a stable coin, okay, let's move here. A stable coin are tradable. Their prices can deviate from par, thus undermining the singleness of money. Deviations from singleness can occur if there are differences in liquidity across stable coins. Okay, or if variations in the quality of the backing or characteristics of the issuer lead to differences in perceived creditworthiness of different issuers. Even higher order uncertainty can arise, such as associated with. All right. So okay, let's stop here. We're gonna stop here. Okay. And I want you guys to really think through this a little bit. I don't want to put everything in one video. Look, we're okay. As you guys can see from the document scroll right here, we're this way of information. I've done the whole thing, right? I highlighted, I read it, everything. But we're gonna stop here. If you guys want another second part of this, let me know in the comments. But yes, guys. But I want to clarify. A lot of people would say like, when was this out? So of course, the BIS Annual Economic Report 2023. Now they published it this year, and it was on September. They did it on September. They published it on September. This was already written, I think, at this year. But yeah, September 2024. This is not all. This is new, and I'm just showing you guys everything. I know you guys are overwhelmed, and me too, but this is an amazing time to actually come here and show you what of work I've done here, because telling you the power of research is insane, and this is insane. There's more to this. This is actually, there's even tokenization of credit. We're talking about your credit score. You know what I mean? So credit score. So there's a lot of play here. There's a lot of how these CBDCs going to affect your credit scores. How these new form of digital money can affect your credit score. But that's for another episode. If you guys want that, just let me know in the comments. But with that being said, thank you guys for watching. Make sure you like, subscribe, and share this video, because this is one of the important videos I've ever made. And yeah, this is kind of different. I really like it. But yeah, but without further ado, take care of you guys yourself. And just put your magnifying glass for now for the next episode. Take care. Peace.